Chapter 7 addresses cash and accounts receivables, or various kinds of accounts receivable. I'm not actually going to lecture any over cash. I think you can get that out of the book and through the homework, but certainly if you have questions you want to ask your instructor. I do want to point out one thing from the textbook, and that has to do the difference between this gross and the net method of recording cash. As you know, if a customer pays early, often a company will give them a discount for paying early. So we have two options, the gross method and the net method. The gross method you would have covered in your accounting principles course. So the net method is what's actually new. Let's kind of look at this real quick. We sell $10,000 worth of goods. So we have sales revenue of 10, and this is ignoring the cost of goods sold entry. We're just focusing on the sales revenue. So if a customer pays early, then we won't get the full. In this case, there was $4,000 of receivable. We don't get the full $4,000 because they're going to get an $80 discount. And the gross method is if we want to track the dollar of the discount that customers take advantage of, then we're going to use the sales discount. So we see 4,000 of it is paid early, so we only get $39.20. The other 10,000 of the receivable is paid after the discount period, and so we don't. So we receive the full $6,000 on that. So let's go over and look. If we had an income statement, this is sales. Subtract sales discount of 80. That gives us our net sales. So that's going to be right at the very top of the income statement, starting with net sales. There weren't any operating expenses and et cetera, et cetera. Income before taxes would be $9,920. Now if we use the net method, then that is really going to track the discounts that we're not taken advantage of. So it's a choice of, do we want to track in the accounting system the discounts that we're taking advantage of or the discounts that we're not taking advantage of? If we want to see, what's the dollar amount of our customers that aren't paying early, we would use the net method. So in the net method, we record receivables and sales revenue discounting or subtracting the discount. So instead of 10,000, we record revenue and receivable of 9,800. So when the customer pays early at the gross receivable of 4,000, here we get 39.20. That's what we're going to record, the 39.20 over here. Then at the very end, notice we still have the same entry for $6,000 down here. Cash will come in, but keep in mind we wouldn't have $6,000 in our accounts receivable. So we've got to put the $120, in essence that would have been the discount if they had paid early, put that back in receivable, so we have a balance in receivable of $6,000. Right? We started with 9,800. We have subtracted 39.20. Let's see, what is that? 80. 17 minus 9 is 8. So we have 5,880. So we need to put this additional 120 back into accounts receivable so it has a balance of $6,000. So now, after this debit, there's $6,000 in the receivable, and that's what we're going to decrease it with the cash coming in. The other thing is this $120, the sales discount forfeited. And I want you to understand that's really other revenue. That's going to get reported as other revenue. Down at the bottom, not the bottom, but in another section of the income statement. So we have net sales. It would go all the way down to operating income, all the way through operating income. And then we'll have this $120, and it's considered other revenue, other expenses of $120. Either way, income before tax is still $9,920. But again, it is a focus on what is management wanting to track, and then accountants, we just set up the system to make that happen. Okay? All right, so that is going over gross versus net method. Let's see. All right, so let's pull open our demo problem for accounts receivable. So we're going to look at accounts receivable here. Before we actually do that, your book talks a little bit about this concept of loss contingencies. Loss contingencies are fairly common in accounting, so we need to have a handle on what are they. Well, the word contingent means, if something's contingent, it depends. It all depends on what happens in the future. So a loss contingency is a loss that's contingent on something occurring in the future. So we don't know. So a lot of loss contingencies are lawsuits. So let's say in 2014, a customer sues us, or whoever sues us. Well, we may not actually know until 2016 when the lawsuit is settled. So we may not know whether we're going to win or lose. We won't know whether we win or lose this lawsuit until it's settled, and let's say that's in 2016. So what do we do here in 2014? So once the lawsuit has taken place, do we recognize the loss at the time the suit is filed, or do we wait until when the lawsuit is settled? Well, there are rules and guidelines for that. Two things have to occur for us to record it in 2014. First off, we have to make a judgment. Is it probable that the loss will occur? Meaning, is it likely? Is it probable? Is it probably going to happen that we will lose this lawsuit? If it is probable, then we're likely to record and accrue the loss in 2014. But the second thing is we have to be able to estimate it. We have to be able to come up with a number. So can we estimate it? And if we can put a dollar amount to it, so it's probable we're going to have a loss and we can estimate the dollar amount, then we're going to record that loss and accrue that loss with some sort of liability. So we'll debit a loss, credit some sort of liability account in 2014. Now, I say all of that to point out that bad debt expense here that's associated with accounts receivable. If you're going to sell on credit, you're going to have customers that aren't going to pay. We're going to have bad accounts. And the expense of that is a loss contingency. Do we record this loss in the year of the sale? So if it's 2014 when we sold something to this customer, do we record the loss in the year of sale, or do we wait until we know we're not going to collect it? Well, generally, it's probable there's going to be some of our accounts that we won't collect, and there are ways of estimating it. So it would actually be really rather unusual not to accrue bad debt expense in the year of the sale. Usually bad debt expense is accrued in the year of the sale. Okay, well, let's just go through some things and review some things about accounts receivable. Goes up with debits, goes down with credits. And usually there's a beginning balance. Well, what's the transaction? What creates accounts receivable? Well, that would be sales on account. So we sell on account, and that creates an account receivable. Okay, so that happens now. Then there's two possibilities. If customers owe us money, two things can happen in the future. One is we'll collect our cash. So either we're going to get our money from our customer, or, that's the second option, we don't get our money and we don't collect. If we don't collect, eventually we need to write that customer off, right? We need to get them out of accounts receivable if we're never going to collect. So we will write that customer off. So it may take a couple of years before we decide that we're not going to collect and write them off. But eventually, if we're not going to collect, we'll write them off. Okay, and then I'm going to kind of jump down here. So we start with a balance, we have sales on account, either we collect it or we don't, and then we have our ending balance. Okay, we also have the contra asset, the allowance account. Now the allowance account also will have a beginning balance. And so, let me erase some of this, I'll give myself some space here. So what's the beginning balance represent? Well, this beginning balance is an estimate. And it is an estimate of accounts receivable that we're not going to collect. So the allowance account goes up for estimated amounts. It's an estimate. So again, this beginning balance is an estimate of this accounts receivable of what we won't collect. So how much of this dollar amount will we not collect goes in the allowance account. So the allowance account goes up for estimates, but it's going to go down for actual bad accounts. It's really, think of it as a budget account. Here's what we're estimating, but here's what actually happened. So during the year, when we identify customers that aren't going to collect, we'll write them off. And so I'm going to take them out of my allowance account because it's no longer an estimate, it's an actual. So again, allowance goes up for what we budget, estimate, it's going to go down for actual write-offs. So actual write-offs reduce both the accounts receivable and the allowance for doubtful accounts. Okay, so then, we're going to come down here and we will have a balance, an unadjusted balance. And it could be a credit. We might also have a debit balance for an unadjusted balance. It's possible to have a debit balance before we make our adjusting journal entry. So let's stop and think about it. If we have a credit balance, it's because we overestimated our bad accounts. Now, if we have a debit balance, it's because we underestimated our bad accounts. That actual would exceed our estimate, so we underestimated. Over here, if it's credit balance, our estimate exceeds our actual, so we overestimated. And it's never going to be zero because it's an estimate. Who can estimate with 100% accuracy? Okay, we also will have an adjusting journal entry. Those always happen at the end of the accounting period for bad debt expense, and it is an estimated amount, right? Because estimates go on this side. So we will have our entry for bad debt expense here at the end, right? But debit bad debt expense and credit the allowance account. And then we'll end up with our ending balance. And that's always going to be a credit. It wouldn't make sense for it to be a debit at the very end because we have a debit here. If we have another debit, that means we have more to collect. That doesn't even make sense. Here's what we have a right to receive. So here's what we think we won't receive of that. We can't receive more than that. On the financial statements, we will report the accounts receivable, we will subtract the allowance for doubtful accounts, and that gives us a net realizable value. Net realizable value. So 3 numbers go on the balance sheet. The gross amount of receivable, less the amount we think we won't collect, and net realizable value. You know what the word net means. You know what the word value means. How about this realizable? What does realize mean in accounting? When we realize something, that means cash. So really, it's the net cash value. So we report things in accounting. We also have realized items in accounting. That means the net cash value. The other thing, sales revenue gets matched with bad debt expense. By estimating bad debt expense, we're able to properly match revenue with its related expense. Again, and that's only because we are estimating our bad debt expense. We estimate the bad debt expense. If we knew the accounts that weren't going to go bad, we never would have made the sale, right? So we take of this sales revenue, here's what we think we won't collect of that as well. Okay, so there is the big picture. Now, here's our problem that I've got for us today. So, we've got this company and they need to write off, we've got a customer that filed for bankruptcy that they aren't going to be able to pay us. So if they can't pay us, we need to write them off, correct? So we need to, going back to this, we need to write off this customer because we're not going to collect. And then in this area, I've got a lot of information telling credit sales. Here's our balances for accounts receivable and allowance account. So let's go to the next page and set some of this up. So over here, we've got accounts receivable. We have a beginning balance of $24,000. I also tell us at the very end we have an ending balance of 40. So that's all given over there in the narrative. We have 2 options for the allowance for doubtful accounts. In both cases, we have a 0 beginning balance. Okay, so let's start making some journal entries. The narrative tells us sales on account were for $65,000. So we would have a debit to accounts receivable and a credit to sales of $65,000. So let's go ahead and make that entry. And then I want to post the $65,000. Let's go post that to our accounts receivable. So there's our credit sales. Also, we are also told that they're going to write off, $600. So if we do have a write-off, let's go ahead and figure that out. Let's recall write-offs reduce each of these. I'm going to hold off and make that our journal entry 3. So what that's going to do, we know we have beginning balance, we have credit sales, we have a write-off, and we have ending. What we don't know here for transaction number 2 is cash collected. So again, we know beginning, credit sales, we don't know how much was collected, but we know how much of that was written off, and then our ending. So, add these two together, 89,000 minus 600 minus what equals 40,000. You should get 48,400. Okay, so we just saw for cash would have come in of $48,000, and we'll reduce accounts receivable. Okay, so we've got that. Let's go ahead and make journal entry number 3. We're going to reduce the allowance account, 600, and reduce accounts receivable, 600. And that was already in the narrative, provided us that number. Okay, so let's go read option A. Option A, make journal entries for the percentage of sales method and show the effects on the income statement and balance sheet. Okay, there are 2 approaches. Approach number 1 is the balance sheet approach. The balance sheet approach is going to focus on the relationship between accounts receivable and the allowance account to come up with our estimate. So what we'll do is we're going to look at that $40,000. So recall, there's $40,000 in accounts receivable. Some accountant went in and detailed this out. So went in and looked to see, okay, how much of this is due within, only 30 days? How much of this, how much of this is really past due, and it's due, so it's 31 to 60 days old. How much of this is even 90 days past due, and how much of this is more than 90 days? And because we break that out, if you add all this up, you're going to get $40,000. So this is our accounts receivable, right? Here's the detail. So most of the accounts receivable is current. And so if it's current, it's more likely we're going to collect it. But as it gets older, and older, and then very old, it's very unlikely we're going to collect it. So this allows us to have, in this case, we have 4 pools, right? So we have 4 ages or 4 pools of accounts receivable, and that allows us to arrive at a very specific estimate. So we're really estimating what should be the balance in our allowance account. So, 26,000 times 1%, 260. 9,000 times 4% is 450. 4,000 times 15% is 600. And then 1,000 times 69% is 690. Okay, then let's add those all up, and we'll get $2,000. So we go through all of that to determine, according to our estimate, the balance in the allowance account needs to be $2,000, okay? So what we just determined is that if we use the balance sheet approach, we just estimated what should be the balance in the allowance account. Okay, well, let's go back up here. We have an unadjusted balance. We have an unadjusted balance of a debit of 600 because we underestimated. We estimated 0, but we actually had $600 of write-offs. So now we need to solve for what is going to be the dollar amount, transaction 4, of our bad debt expense. So minus 600 plus what equals 2,000. This needs to be 2,600. So if I start with a negative 600, add 2,600, I'll get a balance of 2,000. Okay, let's go down here and write our entry for bad debt expense. $2,600, increase the expense, and we will also increase the allowance account for 2,600. And we've already posted that in essence. Okay, so that's option A. And so in option A, we're going to report on the balance sheet this $4,000. And then allowance for doubtful accounts, 2,000, it's a negative, right, a contra asset. So our net realizable value, I guess I left off a 0, didn't I? 40,000 minus 2,000, we have net realizable value of 38,000 on the balance sheet. Now how about the income statement? Sales less bad debt expense. Well, here's our sales, 65,000. And then here is our estimated bad debt expense. So, I'll put it in as brackets because expenses do reduce revenues on the income statement. Okay, so that's what, under the balance sheet approach, how everything would look. The other method is going to be looking, you know what, I'm sorry, percentage of sales. I said this backwards, didn't I? I'm sorry. I did this backwards. So, if you will, I'm sorry, I did this in my classroom today too. So, aging of receivables. I switched these. If you want, you could just do an arrow here. But I switched these methods. And the reason why is in a lot of books, it will be a percentage of receivables, and so the aging is a percentage of receivables. It's also aging them. So we'll just switch these out. Percentage of sales. Sorry, I turned those around. Percentage of sales method. Okay, so we're going to go to B. We're going to make B the percentage of the sales method. And again, it's going to be called the income statement approach. So my apologies, just switch those around, A and B, because that's what I've done. Okay, so we have the percentage of sales method. Up here, we are going to estimate bad debt expense to be a percentage of sales. So the focus here on the income statement method is to look at the causal relation. If we didn't sell on account, we wouldn't have bad debts. So again, we are going to say bad debts. We're looking at a relationship. This is probably some percentage of sales. And so that's what we'll see here. Okay, so for option B, so here's this one was the balance sheet approach. And over here, we're going to look at the income statement approach. Again, we have a 0 beginning balance. And we're going to have the same entries. Debit accounts receivable, 65,000. Credit sales, 65,000. Debit cash, credit accounts receivable, that's not going to be any different. So the first 3 journal entries are identical. And the write-off. So those are going to be the same. It doesn't matter which method I use. So the only thing, so we've got those 3, 65,000, 48,400 at 600. So we'd still have that in accounts receivable. That's not going to change. And we also will have this $600, right? Post this $600 reduction in the allowance account. So again, we'll have this unadjusted balance of 600. So we're at the same point as option A. Okay, this time, when we go to estimate bad debt expense, we're really just going to say, okay, there's $65,000 of sales, and we are estimating that, what did I say, 4.2% of that? 4.5, sorry, 4.5% of that is uncollectible and bad. So when I arrive at that, that gives us a balance of $2,925. Okay, so we'll make our journal entry, debit bad debt expense, $2,925, credit the allowance, $2,925. Okay, so for number 4, this is how I get the number, and it was, again, the narrative gave us the 4.5%. So this time we would have, again, sales revenue, same amount, $65,000, but our bad debt expense is not $2,600, it's $2,925. And then, let's see, I didn't post to the allowance account, did I? We would have $2,925 was transaction 4. And then this time, we just figure out the ending balance. So negative 600 plus 2925 gives us 2,325 as our ending balance. So where we had to back into the bad debt expense, this time we directly solve for bad debt expense, and then I guess you could say back into or solve for our ending balance in the allowance account. So now the allowance account will have that 4,000. Our accounts receivable will be again 40,000, and then this time our allowance account is 2,325 for a net realizable value of 37,675. And we would, I mean, it's reasonable. We have 2 different methods of estimating. They're close, right? The net realizable value is close, but it's not going to be identical. So you should have numbers that are in the same ballpark, but you shouldn't expect that they're going to be identical because we have different estimates. Okay. So that finishes this. Number 1, what's the effect of writing off the $600? Let's go look at that. So let's talk about that a little bit. Before the write-off, let's see, what did we have? We had a beginning balance of $24,000. We had sales of $65,000, and there were collections of cash of $48,400. So let's look at the balance before the write-off was $20,600, and then over here we had a balance of 0. So right before the write-off, net realizable value, accounts receivable less the allowance, was $20,600. Remind ourselves. Okay, and then we had a write-off, which reduces the allowance and accounts receivable. So we debited the allowance, credit accounts receivable. After that, then we had a balance of $20,000 and a debit balance of $600. I add those 2 debits together and I get net realizable value of $20,600. So there is no impact. So the effect of a write-off, no change in total assets on the balance sheet. So for our balance sheet, there's no change in total assets. And no impact on the income statement, right? Because we didn't do anything to bad debt expense. So it really doesn't do much to the balance sheet. Now it does change the detail. Instead of $20,600, we'll report $20,000 on the balance for accounts receivable. So it changes the detail, but not total assets. Net realizable value has no impact. That one's a little bit awkward. Let me do another little demo of this. Let's set it up this way. Let's do accounts receivable Let's do our allowance. And let's set up net realizable value. So let's do another one. Let's say that we have $100, 10, and so $90 net realizable value. So let's say we have that before a write-off. So we estimate of the $100 we won't collect 10. So let's write off 7. So if I write off 7, that reduces accounts receivable and it reduces the allowance account, right? Both of those get reduced with the write-off. So after the write-off, accounts receivable is 93, the allowance account is 3, 93 minus 3, still 90. So no impact. The write-off has no impact on total assets. So the bottom line, no real effect on the balance sheet, and it does absolutely nothing to the income statement. Okay, one last thing. Now, what about if this $600 customer comes back 2 years later and pays us $100? So, maybe they just felt really bad that they hadn't been able to pay and things are going better for them, so they come back in and want to make a payment. So what do? Well, this is 2 years later, so we're going to have a different balance in receivable, a different balance in the allowance account. And by the way, these are going to be the balances before we get this collection. Well, there's a couple of ways of thinking of this. One is, keep in mind, we have already written this customer off. We already took them out of accounts receivable and out of the allowance account. So we could just put, not the whole 600, but we could put, the amount we're collecting back in. So if we do that, we're just going to reinstate their account receivable. So recreate the account receivable, and then, put them back in the allowance account as well. And I won't do it for the full 600, just the 100 that I know I'm getting. That's part one of it. And then part two is then, once I have them put them back in accounts receivable, just record it like any collection, right? Cash comes in, accounts receivable goes down. Let's post that. So we've got $100 here and $100 here. So it can be a two-step process. Reinstate the account receivable and then record it like any collection. Now, if you step back, think of a shortcut way of actually recording this. Well, the shortcut is to omit the debit and credit to accounts receivable because these cancel each other out, don't they? So the other way of recording this is just to do this. Debit cash, credit the allowance account. So we could have made it in one entry. Just do this. Debit cash, credit the allowance account, because these two offset each other. But I do find most students prefer doing it in 2 steps just because it mostly just makes sense to do it that way. I mean, you can understand the reasoning. It's hard to reason, why would I debit cash and credit the allowance account? It doesn't make as much sense. Okay, one last thing before I stop. Let's go back. It is possible then to have these kind of transactions in the accounts receivable and the allowance account. So let's go back to our theory back over here. It could be that we may collect a written off account. And if we do that, we increase this, and then we also, so collect a write-off. I'll just, on this side, I'll just say we collect a write-off. So it's possible to have a debit and credit for that. And it's also possible then we'll have another credit over here because we will collect an account written off. Okay, so again, just adding those in because that's another possibility of something that could go in and out of this account. Oh, one last thing, when you're doing your homework and you are arriving at, bad debt expense, these estimates, especially if you're estimating bad debt expense as a percentage of sales, it will be a percentage of net sales. let's go back over here where we did this. So just for your notes, this should be your net sales amount, not gross. So if you have sales returns or you discounted the sale, you're not going to collect that. We know that already. So you shouldn't even have any accounts receivable. So again, when you're estimating bad debts, do it as a percentage of net sales.